The year is 1677. Amsterdam, February. A merchant sits in a tavern on the Herengracht, the most prestigious canal in the richest city on earth. In front of him, on the table, sits a small brown object. Unremarkable, ugly even, it looks like a dirty onion. But this small brown object is worth more than his house, more than his neighbor's house, more than both houses combined. It is a single tulip bulb, a Semper Augustus, the rarest, most coveted variety in the most fevered speculative market the world had ever seen. At the peak of what historians would later call Tulip Mania, a single bulb of this variety changed hands for 10,000 guilders. To put that in perspective, a skilled craftsman in Amsterdam in 1677 earned about 300 guilders per year. This tulip bulb cost 33 years of wages, and our merchant paid it gladly because he was certain, absolutely certain, that next month, next week, perhaps tomorrow, someone would pay him even more. He was not stupid, he was not crazy, he was not uniquely greedy. He was human, and humans, it turns out, make the same mistake over and over and over again. Every generation, without exception, throughout history, the assets change, the technology changes, the story changes, but the psychology, the fever, the certainty, the collapse stays exactly the same. Tulips in 1677, the South Sea Company in 1720, railroads in the 1840s, Dotcoms in 2000, housing in 2008, and Today we may be living inside not one bubble, but several simultaneously. The question is not whether you believe that. The question is whether you understand the pattern well enough to protect yourself. Because history shows very clearly that most people do not. Even the smartest people. Isaac Newton, perhaps the greatest mind in the history of human civilization, lost the equivalent of $3 million today in a financial bubble. After losing it, he said, "I can calculate the movement of stars, but not the madness of men. If Newton could not resist the bubble, what chance do the rest of us have?" My name is Nex. I watch the past to understand the present. Tonight we are going to travel through 400 years of financial manias, bubbles and collapses. Not to entertain you, but to give you a tool that history has already built and that most people refuse to pick up. Let's begin. Part 1. Tulip Mania, the bubble that started it all. To understand the tulip bubble, you first need to understand why tulips mattered. In 17th century Europe, tulips were not just flowers. They were status symbols of almost incomprehensible power. The tulip had arrived in Western Europe from the Ottoman Empire in the mid-1500s. It was exotic, beautiful, and unlike anything European gardens had ever produced. Its colors were vivid and unpredictable, caused, though nobody knew it at the time, by a mosaic virus that created spectacular streaks and flames of color on the petals. For the newly wealthy merchant class of the Dutch Republic, the most prosperous society on earth in the 1600s, owning rare tulip varieties was the ultimate display of sophistication and wealth. The Dutch Republic itself was a financial miracle. It had invented the modern stock exchange, the modern bond market, limited liability companies, and the concept of futures contracts. Amsterdam was the financial capital of the world, and the Dutch were, quite simply, the most financially sophisticated people alive, which makes what happened next all the more instructive. By the early 1630s, a market for tulip bulbs had developed with all the characteristics of a modern financial market. Bulbs were bought and sold on exchanges. Futures contracts were written, agreements to purchase bulbs that had not yet been dug up, at prices agreed today for delivery months in the future. Prices began to rise, then rise faster, then faster still. Between 1634 and early 1637, the price of some tulip varieties increased by a factor of 20, 50, 100. People who had invested early were becoming rich, visibly, dramatically, undeniably rich, and so more people invested, craftsmen, merchants, farmers, people who had never speculated in their lives, people who mortgaged their homes to buy tulip futures they did not fully understand. Sound familiar? The justifications were entirely rational sounding. Tulips are genuinely beautiful and rare. The Dutch are genuinely wealthy and sophisticated. Demand from wealthy Europeans is genuinely growing. This is not speculation. This is investment in a real asset. Every single one of these statements was true, and none of them justified a single tulip bulb costing 33 years of wages. In February 1677, at a routine bulb auction in Haarlem, something unexpected happened. The auctioneer opened bidding, and nobody bid. Not at the expected price, not at any price. The buyers simply were not there. Word spread instantly through the tightly networked Dutch merchant community. Within days, prices collapsed, not gradually, catastrophically. Bulbs that had sold for thousands of guilders were suddenly worth hundreds, then tens, then almost nothing. The futures contracts that people had signed, contracts to buy bulbs at prices that now exceeded their market value by 10 or 20 times, became worthless. Fortunes built over years disappeared in weeks. The Dutch government, overwhelmed, eventually allowed most futures contracts to be cancelled for a small fee, acknowledging that the legal system could not handle the volume of defaults. Here is the first lesson of the bubble pattern. The collapse is always faster than the rise. It takes years for a bubble to inflate. It takes days, sometimes hours, for it to burst. Because a bubble is not built on value, it is built on belief. And belief can disappear overnight. Part 3. Railroad Mania. The bubble built on a real revolution. Here is where the story gets more complicated and more relevant to today. Because the tulip bubble was built on an irrational overvaluation of a fundamentally decorative object. The South Sea bubble was built on fraud and a fictional business model. But what happens when the bubble is built on something real? What happens when the underlying technology genuinely is revolutionary? England 1840s. The railroad is real, it works. It is transforming the country before everyone's eyes. In 1830, the first passenger railway opened between Manchester and Liverpool. By 1840, thousands of miles of track existed. Journey times that had taken days by coach now took hours. The economic implications were genuine and enormous. And investors understood this. They were not wrong that railroads were revolutionary. They were not wrong that railroads would transform commerce. They were not wrong that money could be made. They were wrong about something more specific. They were wrong about which railroad companies would survive. They were wrong about how long it would take to become profitable. They were wrong about how much capital the build-out would require. They were wrong about how many competing lines the market could support. Between 1844 and 1846, the British Parliament approved the construction of over 9,000 miles of new railway lines. Thousands of separate railway companies were formed. Shares were sold to an eager public that could not get enough. Farmers, clergymen, shopkeepers, aristocrats, everyone invested in railways. By 1845, railway shares represented nearly half of all investment activity on the London Stock Exchange. Then reality arrived. Construction costs were massively higher than projected. Many routes were economically unviable. They ran through areas with insufficient traffic to ever justify the investment. The capital calls began. Companies demanded investors pay their remaining share subscriptions in cash. People who had bought shares on margin, paying only a fraction of the purchase price upfront, suddenly had to find large sums of cash they did not have. The crash of 1847 wiped out enormous wealth. Thousands of investors were ruined. Many railway companies went bankrupt. But here is the crucial point that makes this bubble different from the others. The railways survived, not all of them. not the companies that investors had bought shares in, not the specific bets that people had made, but the technology survived, the infrastructure survived. Britain ended up with an extraordinary railway network that transformed its economy for generations. The investors lost, the civilization won. The third lesson: a real technological revolution does not guarantee that investors in that technology will profit. The technology can be completely real, completely transformative, completely world-changing, and most of the companies built around it can still go bankrupt. Amazon is real. Pets.com was also real. For a while, the internet was real. So were the 1,000 dot-com companies that no longer exist. Knowing that the technology will change the world tells you almost nothing about which specific investments in that technology will make you rich. Part 4. The dot-com bubble, the railway mania with better graphics. The year is 1999. The internet is real. Nobody serious disputes this. Email has transformed communication. E-commerce is beginning to reshape retail. The web is connecting people and information at speeds and scales never before imagined. This is a genuine revolution. The greatest since the printing press, perhaps greater. And Wall Street has decided that normal rules of valuation no longer apply. Traditional investing says a company is worth the present value of its future profits, but the new internet companies have no profits. Many have no revenue, some have no business model at all. No matter. The new metrics are eyeballs, website visitors, mindshare, first mover advantage, network effects. In this new economy, you have to spend money to capture users, and once you have the users, the money will follow. Trust us. Pets.com raised $82.5 million in its initial public offering. Its business model: sell pet food online and deliver it to customers' homes. The problem: pet food is heavy, bulky and cheap. The cost of shipping a bag of dog food exceeded the selling price. Every sale lost money. The more they sold, the more they lost. They spent $11.8 million on advertising in a single year, including a famous sock puppet mascot that appeared at the Super Bowl, while generating only $619,000 in revenue. Pets.com went bankrupt 9 months after its IPO. But here is what makes this interesting. Amazon.com also had no profits in 1999. Amazon.com also had a stock price that bore no relationship to its current earnings. Amazon.com also burned cash at alarming rates. The difference between Amazon and Pets.com was not obvious in 1999. Both were internet companies. Both were losing money. Both had passionate believers. Amazon survived because it had a genuinely scalable business model, extraordinary management, and a founder willing to think in decades rather than quarters. Pets.com died because it was trying to solve a problem: the last mile delivery of heavy, cheap physical goods that the internet could not solve profitably in 2000. Between March 2000 and October 2002, the Nasdaq Composite Index fell 78%. Trillions of dollars of wealth evaporated. The fourth lesson: in every bubble, some investments survive and become the foundation of the next economy. Most do not. The challenge, the maddening, impossible challenge, is that you cannot reliably tell which is which while the bubble is inflating. In 1999, most people could not reliably distinguish Amazon from Pets.com. In 2024, it seems obvious, but that is hindsight. And hindsight is not available when you need it most. Part 5, 2008, the bubble that almost broke the world. We need to spend a moment on 2008, not because it is the most interesting bubble historically, it is not, but because it introduced something new. something that makes it uniquely relevant to where we are today. Every previous bubble we have discussed was essentially a private market phenomenon. Investors made bad decisions, they lost money, the economy suffered, but the losses fell primarily on those who had taken the risks. 2008 was different. 2008 was a bubble deliberately inflated by the institutions whose job it was to prevent bubbles. The Federal Reserve kept interest rates artificially low for too long after 2001, flooding the financial system with cheap money that needed somewhere to go. Regulators looked away as mortgage standards collapsed, as banks issued loans to people with no income, no jobs, no assets. Rating agencies stamped AAA on securities that were built on those worthless loans. Wall Street packaged and sold these securities globally, spreading the rot through the entire financial system. And when it all collapsed, the losses did not fall primarily on those who had taken the risks. They fell on ordinary people, on homeowners who lost their houses, on workers who lost their jobs, on pensioners whose retirement savings were decimated, and on taxpayers who were told that the banks were too big to fail and had to be rescued with public money. The fifth lesson, and the most important one for understanding today, the most dangerous bubbles are the ones that central banks and governments help create, because when those bubbles burst, the losses are socialized, spread across society, while the gains have already been privatized. And because the response to the collapse typically involves even more money printing, even lower interest rates, even more debt, which plants the seeds for the next bubble, which brings us to today. 6. The anatomy of every bubble. Before we look at today, let us establish the pattern clearly. Every bubble in history, tulips, South Sea, railroads, dotcoms, housing, follows the same 5 stages. Stage 1, displacement. Something genuine changes, a new technology appears, a new market opens, a new financial instrument is created, interest rates fall dramatically. Something real happens that creates a legitimate new opportunity. This is crucial. Every bubble starts with something real. That is what makes it so dangerous. Stage 2, boom. Early investors recognize the opportunity. They invest. Prices rise. Rising prices attract more investors. Media coverage increases. Success stories circulate. My neighbor made a fortune. My brother-in-law doubled his money. Why am I missing this? Stage 3, euphoria. Normal valuation metrics are abandoned. Traditional measures of value, earnings, cash flow, yield are declared obsolete. New metrics are invented to justify rising prices. Experts appear on television explaining why this time is different, why old rules no longer apply, why the sky is the limit. This is the most dangerous stage. This is when the most people enter. This is when the most money is lost. Stage 4, profit-taking. The smart money, the insiders, the early investors, begins to quietly exit. They are not announcing this. They are not warning you. They are selling to you. Prices may continue to rise for a while on momentum and new buyers, but the foundation is cracking. Stage 5, panic. Something triggers a loss of confidence. It could be a major default. It could be a regulatory announcement. It could be a single failed auction, like the Tulip auction in Haarlem in 1637. Prices begin to fall. Falling prices trigger more selling. More selling triggers more falls. The spiral is vicious and fast. People who bought on margin are forced to sell to meet margin calls. This selling drives prices down further, which triggers more margin calls, which triggers more selling. The bubble deflates, not slowly, not gently, but catastrophically. And then the recriminations begin. The congressional hearings, the newspaper investigations. The question everyone asks, why didn't anyone warn us? The answer is always the same. People did warn you. You did not want to hear it, because when the bubble is inflating, the people warning you look foolish, and the people telling you that this time is different look like geniuses, until they don't. Part 7. Where are we now? This is the question you have been waiting for, and I am going to answer it carefully, because this is where honest analysis requires real precision. I am not going to tell you that a crash is coming tomorrow. I am not going to tell you which asset will collapse first. Anyone who tells you that with certainty is selling you something. What I can tell you is where the indicators of bubble behavior are flashing. The stock market. The US stock market, as measured by the Shiller-Cape ratio, a measure of how expensive stocks are relative to their long-term earnings, is at levels exceeded only twice in history, in 1929, just before the Great Crash, and in 2000, just before the dot-com collapse. This does not mean the market will crash tomorrow. Markets can remain expensive for years, but it means the margin of safety is thin. Artificial intelligence. The AI revolution is real. Nobody serious disputes this. Just as the railroad was real in the 1840s, just as the internet was real in the 1990s, the technology will transform the economy, genuinely, profoundly, permanently. But remember the railroad lesson. The technology can be completely real, and most of the companies built around it can still fail. The question is not whether AI is real. The question is whether the current valuations of AI-related companies accurately reflect realistic future earnings, or whether they reflect the same kind of euphoric extrapolation that drove Pets.com to $1 billion valuation. Government debt. The United States has $36 trillion in national debt. It is adding roughly $2 trillion per year. Interest payments now exceed $1 trillion annually. This is the bubble that most people are not watching, because it does not look like a bubble, it looks like a policy choice. But government debt that grows faster than the economy indefinitely is not a policy choice. It is a mathematical problem that has only a limited number of solutions, all of them painful. Higher taxes, spending cuts, default, or inflation, the hidden tax that destroys savings while allowing governments to repay old debts in cheaper money. History suggests that governments almost always choose the last option, which brings us back to Weimar, which brings us back to Rome, which brings us back to every empire that tried to borrow its way to prosperity and ended up printing its way to collapse. Real estate. In most major Western cities, housing prices relative to incomes are at or near historic highs. A generation of young people cannot afford to buy homes in the cities where they work. This is not a temporary supply problem. It is a structural consequence of decades of low interest rates and policy choices that inflated asset prices. Part 8. Who survives the bubble? The pattern across 400 years. In every bubble we have examined, Tulips, South Sea, railroads, dot-coms, housing, the same types of people survived. And it was never the people who correctly predicted the timing of the crash. Almost nobody correctly predicts timing. John Maynard Keynes, perhaps the greatest economist of the 20th century, famously said that markets can remain irrational longer than you can remain solvent. He was right, and he nearly went bankrupt several times trying to short overvalued markets. The people who survived were not the ones who called the top. They were the ones who never concentrated their entire wealth in the bubble asset. The diversifiers. In every bubble, there were people who participated, who owned some of the bubble asset, but who also held other things: land, gold, foreign currency, productive businesses. When the crash came, they lost some. They did not lose everything. The holders of real assets. In every financial crisis throughout history, from Weimar Germany to the Tulip collapse to 2008, real assets held their value relative to paper claims. Land still produced food, gold still had purchasing power, a functioning business still generated cash flow, a skill still commanded a wage. Paper claims, Bonds, currency, financial instruments are always at risk when the system they depend on comes under stress. Real things are harder to destroy. The people who ignored the story. In every bubble, there is a compelling narrative that explains why this time is different. The Dutch are the most sophisticated investors in the world, and they are buying tulips. The internet is going to change everything, and you need to own internet stocks now. Housing never goes down nationally. You cannot lose money on real estate. The people who survived were often those who simply did not find the story compelling enough to bet everything on it. Not because they were smarter, but because they were more skeptical or more boring. There is genuine virtue in financial boredom. 9. The practical lesson. So what do you actually do with this? I am not a financial advisor. This is not financial advice. Every person's situation is different, but history does offer some clear principles that have held across 400 years and dozens of financial crises. Never put everything in one asset. This sounds obvious. It is violated constantly. In every bubble, people concentrate. They sell diversified holdings to buy more of the thing that is going up every time. The tulip buyers sold their houses. The dot-com investors put their retirement savings in Nasdaq. The housing bubble investors took out home equity loans to buy investment properties. Concentration amplifies gains on the way up. It amplifies losses on the way down. Understand the difference between price and value. Price is what someone will pay for something today. Value is what something is genuinely worth based on its fundamental characteristics, its earnings, its scarcity, its utility. In a bubble, price diverges dramatically from value. The divergence can persist for years, but it always, eventually corrects. Hold some things that cannot be printed. Every financial crisis in history has involved some form of monetary debasement, either directly through inflation or indirectly through financial system stress. Things that cannot be printed, gold, land, certain commodities, have consistently served as stores of value through these periods. This does not mean they never fall in price. They do, but they do not go to zero. They cannot be created from nothing by a government facing impossible obligations. The goal is not to get rich from the bubble. The goal is to still be financially functional after the bubble bursts. Getting rich from a bubble requires extraordinary timing and discipline. Buying early, selling before the crash, resisting the temptation to go back in. Almost nobody achieves this consistently. Isaac Newton again could not do it. The realistic goal is simpler. Do not be destroyed. Participate modestly. Hold real assets alongside paper ones. Do not bet the farm. And when everyone around you is saying that this time is different, remember Harlem, 1637. Remember the South Sea Company, 1720. Remember Pets.com, 2000. It is never different. The assets change. The story changes. The human psychology does not. Outro. The madness of man. Isaac Newton. Arguably the most brilliant human being who ever lived. He discovered gravity. He invented calculus. He explained the motion of planets. And he lost $3 million in today's money to a financial bubble. After it happened, he refused to ever discuss the South Sea Company again. The word South Sea was not to be spoken in his presence. He was not stupid. He was not uniquely greedy. He was human. And in the grip of a bubble, surrounded by people getting rich, watching prices rise every day, hearing the same compelling story repeated everywhere, even the greatest mind in history could not maintain his rationality. This is not a story about stupidity. It is a story about the limits of human psychology when confronted with social proof and the fear of missing out. We are all Newton. Every generation, every bubble, The tulips of 1637 are gone. The South Sea Company is a footnote. The Dotcom stocks are museum pieces. But the pattern, the displacement, the boom, the euphoria, the crash is as alive today as it was in that Amsterdam tavern 400 years ago. The question is not whether you will encounter a bubble in your lifetime. You are almost certainly living inside one right now, possibly several. The question is whether you will be the merchant who mortgaged his house for a tulip bulb, or the merchant who admired the flower, bought one or two and kept his house. History cannot tell you when the crash will come, but it can tell you what always happens next. My name is Max. I watch the past to understand the present. The madness of man is not a flaw in the system, it is the system. The only protection is knowing the pattern well enough to recognize it before you are too deep inside it to get out. Subscribe and let's survive history together. See you in the next era.